Hello guys, Dmitry Bonder there. Today we will be talking about the thing that can make you incredibly rich or you can make you lose all your money. It's very risky topic and it's very dangerous. Have you already guessed what we'll be talking about? Yes, it's a margin. Margin can refer to many things in the world of finance, but when it comes to investing, buying on the margin involves borrowing money from your broker to buy securities such as stocks or bonds. And in simple words, margin is the difference between the total value of investment and the amount you borrow from a broker. So basically, you're using your cash or securities you already own as a collateral to more investments in hopes of making a profit. As with other loans, you have to pay back the money you borrowed plus interest. But margin trading comes with the risks. If the amount you borrowed gets too large relative to the value of your securities, you will have to deposit more and more funds. Otherwise, your broker may sell off some of your assets. And remember, even if you lose your entire investment, you still have to repay what you borrowed with the interest. That's why it's so dangerous. And in most simple terms, a margin account is a stock trading account that you can go ahead and invest an extra dollar for every dollar you have. So you can basically create a debt. If you believe in a stock a lot and you have $100 in your account, you can invest an extra $100 into the stock. So you can have $200 actually invested in this stock, even though only $100 is yours. But a margin account allows you to be able to invest a lot more money than you have. You've basically issuing a kind of debt, but the big problem that makes margin very scary is, let's say you have $100 and then you invest other $100 in debts also in that stock, so you have $200. You will invest this sum although only $100 is actually yours and the other 100 just a debt. So let's say the stock went down 50%. You will lose all of your money if that stock went down just 50% because then it goes down to $100. But remember, the brokerage is the one that always gets their money first, and if there is only $100 left there, that's their money. So at this point you lost everything, you lost all of your money. Whereas if you just invested in that stock regularly in a regular brokerage account, you didn't go on margin and you didn't take debt and used your own $100. In this situation, if the stock would have to go 100% for you to lose 100% of your money, if it went down 50%, you would still have $50 left. So it's very different to work with a margin and without margin. Okay, but what happened if the stock doubled? What if that stock went up 100%? Well, if you had your $100 invested and that's it, and you didn't have any margin, then you would have $200 right there because you have got $100. It doubled now and you have $200. But if you had $200 invested, so you had $100 of your own and $100 of debt, and now you have $400, but $300 of that dollars is yours. So that is the power of margin. You can make so much money investing on margin if you are picking the right stocks and doing the right things, and you can just make a lot of money. But on the downside, if stocks start doing bad, you pick up a bad one to go into, you can get a hammer and lose everything, even without that stock, losing all its money just because you can't pay the debt and you get what is called a margin call. I'm not your investment advisor, please, I'm just a YouTuber, so don't trust all my words. Make your own research and make your own decision when you're using margin. Now we know what the margin is, so let's figure out what are the requirements for getting in. I'll take a Robinhood app as a great example how to use it. To use a Robinhood margin, a person should have a Robinhood Gold account to be able to trade with the margin. Investors with a Robinhood Gold accounts pay a monthly subscription fee of $5. At this level, users gain access to the professional research report to help them decide which stocks to buy or sell, and up to 1,000 interest-free margin. Moreover, they can make a large instant deposit over $50,000. I use it several times, I really like it, but please be very careful. So to purchase a security on margin, Robinhood requires that you have at least $2,000 or 100% of the security's purchase price, whichever value is less, deposited into your account. This is called the margin minimum. But investors designated as a pattern day traders must have 25,000 in portfolio value to access margin. So the total amount of money that is available for trading is equal to the sum of money on your account. And of course, you can also increase your margin limitation. As long as your account is not in a deficit, if you are not in a margin call, the amount of margin that you can use goes up when you add more money to your account. However, if you have a borrowing limit set on your account, your available margin will not increase above that limit. So let me give you an example. If you have 2,000 cash in your account, you can usually invest up to 2,000 with a margin. If you increase your cash portfolio value minus any cryptocurrency position, it's also important, to 3,000 by depositing 1,000, your available margin will typically increase to 3,000. However, if you set a 2,000 borrowing limit, your available margin will not go up regardless of how much you deposit. So you can change all these settings in your account, and I will show how to do it. Okay, so open the app and type on the account icon, which is at the bottom right. On the next screen, tap on investing, and once you tap on it, scroll down and you will see the option set a borrowing limit. Go ahead and tap on it. On each screen, you should be able to set a borrowing limit, so go ahead and enter the maximum amount you want to work with. Once you enter the amount, go ahead and tap on the set borrowing limit. Okay, now let's talk about Robinhood's margin maintenance requirement. Margin maintenance is the minimum portfolio value Robinhood requires you to have to avoid a margin call, and that's really important. For instance, if you have $10,000 in Tesla stock bought on a margin, Robinhood may set a margin maintenance requirement at 25%. It means you'll need at least $2,500 in account equity to avoid a margin call. So Robinhood looks at the factors like a stock volatility and market liquidity to determine the margin maintenance requirements. That's how it works. Essentially, more volatile stock will have the higher margin maintenance requirements. So be very careful with the Tesla or GMC or other stocks like this. And Robinhood keeps adjusting its margin maintenance requirements based on the volatility and liquidity factors as well. So you may start with a margin maintenance requirement of 25% and stocks see its increase, let's say, to 35%. Therefore, you may start with the margin maintenance requirement, let's say, of 25% on a stock and see it increase to 35%. That's okay, that's how it works. And Robinhood online broker charges 2.5% annual interest on the margin. I have video about this margin decrease from Robinhood on my channel, please check it out. The platform used to charge 5% interest but half the amount to entice more investors to purchase a premium gold account. It's important to say that the interest applies to amounts above 1,000 and is calculated on a daily basis. Okay, what is a margin call? Let me explain and how to cover it. A margin call happens when the value of your portfolio falls below the margin maintenance requirement. A margin call is when the broker contacts you and asks you to deposit funds or securities to bring the account up to the margin maintenance minimum. If you get a margin call, there are only two ways to solve this problem. So the better one is depositing additional funds in your account. But if you can't deposit the asset quickly, you can resolve a margin call by selling some stocks to boost the portfolio value. So Robinhood can liquidate your position if you continue to ignore its margin calls. They will not be asking you about this. And note that Robinhood doesn't necessarily have to tell you before he starts selling your assets. It's a margin agreement that you signed when you took their money. So for example, let's look at the GameSpot short squeeze as a form of the margin call. It was one of the biggest margin calls ever. A short squeeze occurs when the shorted stock jumps in the value due, for instance, to a sudden piece of favorable news. Short sellers are then forced to buy back the stock they had initially sold in an effort to keep their losses from mounting. Purchasing the stock to cover their short positions raises the price of the shorted stock, thus triggering more short sellers to cover their positions by buying the stock. That's how it works. This results in a cascade of stock purchases and even a bigger jump in the share price. So I have this video as well on my channel. And one more crazy example. How is the margin call relates to Great Depression? So on October 24th, 1929, often called as a Black Thursday, the stock market started falling after a period of rapid growth. More losses followed the next Monday or Black Monday, and Tuesday, Black Tuesday, continued until 1932, when the Dow Jones Industrial Average fell to a rock bottom of 41%, down from the peak of 381. And many factors led up to the crash, but what got many ordinary Americans into trouble as the Great Depression began was the margin. The stock market had been so profitable that many people with limited funds wanted in one action, in one day, to be rich and bought as much shares as they could. So at the time, federal rules allowed them to borrow up to 90% of the stock value. Unbelievable. When the market crashed, many investors couldn't afford the margin calls and lost everything. And you may ask, is margin on Robinhood worth it? Sometimes you want to get to your destination a bit faster. By riding a motorcycle, you can dodge through the traffic and overtake slower vehicles. But it's also riskier than driving a car. You need to weigh the pros and cons and understand the risk you are taking. The margin is similar. What you do with the money you borrow is your decision. So don't trust me. But ultimately, you're on the hook for that amount plus any interest you took from the brokerage. But let me repeat, you need to weigh the pros and cons and understand the risk you are taking. The margin is similar. What you do with the money you borrow is your own decision. But ultimately, you are on the hook for that amount plus any interest. And if your investments rise in the value, great, you're lucky that you could multiply your profits. But if it's going down, oh man, you are on the hook. And trading with a margin can be a smart way to increase your profits in the stock market, especially if you have little capital. Robinhood's 1000 interest-free margin can help you boost trade while keeping investment costs low. You can access larger margin with Robinhood as your account expands. And finally, what I would like to say, Robinhood's 2.5% interest on a margin is among the most competitive in the market. Okay guys, that's all for now. I hope this video was practical and useful for you. If you have any other questions related to margin or Robinhood margin trading, please leave your comments. I'll try to help you. Have a good day and peace out.